Breaking news from the Bank of Canada. They have raised the interest rate by 100 basis points. With more, I want to go straight to James Marple, senior economist at TD Bank. James, good morning to you. There was some speculation that the Bank of Canada would raise the rate more than that 0.75, and in fact they have. Let's get your reaction to that.
Sure. Well, I think it's a recognition that they are behind the curve on inflation. Inflation has come up much more than they would have liked and really what they had forecast. We've seen continuously they've had to revise up their expectations for inflation. I think they've clearly realized that they have to do more and do it a bit quicker in order to bring that under control. I mean, they've been especially worried about rising inflation expectations. They do their own survey of household and business expectations for inflation, and those had been rising, and I think that gave way to the actions they took this morning.
We're going to hear from Tiff Macklin next hour more on the decision behind the hike. But in the meantime, can you explain to our viewers why interest rates are going up and how that is tied to bringing inflation down?
Okay, well, the Bank of Canada doesn't have a lot of levers to try to manage the economy, but its most significant one is its policy rate, its short-term interest rate. And when it wants to slow down the economy because inflation is too high, it raises interest rates, and that ends up reducing activity in things like the housing sector, where of course people must pay higher rates immediately for variable rate mortgages, and also it puts upward pressure on even fixed rate mortgages. So we've already seen that has slowed activity in that sector. So, I mean, this is really an attempt to bring the economy back into balance. We have an economy that demand is strong. That's come as we've had a lot of support, both fiscally and, of course, with very low interest rates, and is a bit supply constrained due to the ongoing issues with the pandemic and, of course, the war in Ukraine pushing up oil prices and broadly commodity prices. So the Bank of Canada can't do too much on the supply side, but it can slow demand, it can slow the pace of sales, and that's what it's doing by raising interest rates.
So, James, critics of the rate hikes are saying the Bank of Canada is, by doing this, just pushing us even quicker into a recession if we're not already in one.
Well, the central bank has a mandate to have prices low and stable, and sometimes when you're behind the curve and inflation is way higher than you'd like it to be, you have to sacrifice a little bit in terms of economic activity in order to get back to target. And certainly that's what we're seeing now is they I think recognize there could be a bit of economic pain. But the starting point is one in which the unemployment rate in Canada hit an all-time low of 4.9%. So they're starting certainly from a position of strength, but and from there really is only one way to go. But they're not trying to engineer a recession, but they have to be willing to accept some economic pain in order to bring inflation to where they need it to be.
Okay, so specifically, how is this going to impact Canadians already dealing with the cost of living going up? What does it mean for mortgages, for credit card payments?
Well, anything that is a variable rate product tied to a variable rate, that includes credit cards, that includes variable rate mortgages, auto loans, all of those things have become more expensive. So if you're looking to make those kind of purchases, the amount you have to pay on interest will increase. It's still a rate that is very much below the rate of inflation. So you're paying a lot more for goods and services beyond the interest rate, and the hope is that if this is successful, we'll start to see that inflation come down. But right now, obviously, we're in a situation in which inflation's high and interest rates are rising. So it's not a great place to be. But I think if the Bank of Canada is successful, and if they get a little bit of luck on some of the supply issues, then we'll be in a much better place in a year or so from now.
In a year or so from now, that was going to be my last question. If you could give us a bit of a timeline. We know that the Bank of Canada wants to see the rate of inflation around 2%. How long could that take, James?
Well, I mean, we do tend to see when inflation moves this high, it takes a bit of time to come back down, certainly to the 2% mark. We are really living in unprecedented times, though. I mean, there were a lot of supply issues that contributed to the current rate of inflation. So it is difficult to say with any degree of certainty how long it will take. But But I would suggest that we won't be back to that 2% rate within the next year. It's going to take longer than that.
James Marple. James is a senior economist at TD Bank. Thank you so much.